If we talk about tech giants raking in massive profits, well, Meta Platforms is right up there at the top of the list. But recently, some confidential internal documents were leaked, and they revealed something pretty shocking, actually. 10% of the company's total revenue may be generated from things like scam ads, illegal gambling, and other prohibited goods. Now, Meta is pouring, hundreds of billions into AI for the future. So the big question is the company building its empire on, dirty money? And maybe more importantly for investors, will this dark revenue source become a liability that could tank the stock's future value? Today, we're diving deep into Meta's dark side. Hello and welcome to Insight AI Brief. Before listening, please remember to like, share, and subscribe.
Yeah, that opening really sets the stage for what we're digging into today. It's a look at some serious systemic risk. And what's really critical for you, the listener, to get right away is where this information is coming from. These aren't just guesses from, outside groups or competitors, no. We're looking at analysis based on confidential internal Meta documents. Things like memos, their own financial projections, safety team presentations, stuff that surfaced pretty recently. And these papers, they paint a very clear picture, a picture where Meta seems highly aware of the sheer scale of the fraud the company is accommodating, maybe even profiting from.
Right, and that's the key for this deep dive, isn't it? When the data is literally coming from their own spreadsheets, their own presentations,
yeah,
you really have to take it seriously. Okay, let's jump straight into those shocking numbers then, because the scale, the quantitative side of this problem, it's absolutely central to understanding the governance crisis here at Meta.
Absolutely. So the headline figure, the one that really grabbed everyone's attention. And remember, this is a projection from late last year, found inside their own documents. Meta apparently expected a staggering $16 billion in overall annual revenue in 2024. And that $16 billion was projected to come specifically from scam ads, sales of prohibited goods, and, other illicit financial stuff. That figure represents about 10% of their total projected annual revenue for the year.
10%. I mean, that's huge. It's one thing if a tiny fraction of a massive business has issues, right? But to have one in every $10 you make potentially linked to something shady, something prohibited, that feels like it fundamentally changes the nature of the business itself. But I noticed the internal documents seem to draw a line between that total dark revenue figure and something they call the highest risk stream. Can we unpack that a bit? What's the difference?
Yeah, that distinction is actually crucial if you want to understand Meta's internal thinking, their sort of risk calculus. The $16 billion, that represents the whole universe of what they internally classify as high-risk revenue. Now, that includes things like maybe misleading financial advice or using brands without authorization, stuff that might get them fined by regulators but isn't automatically, outright illegal. However, they also track the annualized revenue specifically from the highest risk scam ads, and this is the really nasty stuff. Illegal online casinos, fake government bond schemes, selling banned medical products, that kind of thing. Internal documents put that more conservative figure, which is still massive, mind you, at about $7 billion a year.
Wow. So, okay, even if they somehow manage to clean up let's say, the lower hanging fruit like the prohibited products bit, they still face a potential $7 billion revenue stream coming from activities that are, almost certainly illegal and definitely highly exploitative of their users. So it kind of shows there are different shades of dark revenue, maybe. But even the most blatant legally risky part is still generating billions. I mean, $7 billion is enough to run a pretty successful company all on its own.
Precisely. And the fact that they track these different streams, it suggests they're trying to manage how regulators see them. They might be willing to give up some of that larger $16 billion total, perhaps. But the internal goal setting, which we'll probably get into later, it really shows they view that high-risk $7 billion chunk as a persistent, maybe even permanent, and definitely profitable part of their whole ad ecosystem.
Okay, so that's the money side, the revenue. But maybe the real measure of failure here is how much users are actually exposed to this stuff. Yeah. When you look at how often users are apparently running into these scam ads, that $16 billion figure suddenly feels, small compared to the actual harm being done.
Oh, the exposure numbers. They're almost hard to wrap your head around. The documents reveal a deluge, really. Meta Platforms are estimated to show users something like 15 billion high-risk scam advertisements every single day.
15 billion daily.
Yeah. Just think about the logistics of that for a second. If your system, your platform is letting 15 billion potential traps through the net every single day, you're not just, hosting content anymore. You're basically creating a digital environment where the chance of running into fraud is practically guaranteed for users.
15 billion exposures. every 24 hours.
Yeah.
I mean, that number alone just shows why this isn't some small, manageable moderation issue that a few clever algorithms can fix. It really suggests the system itself is structurally geared towards ad delivery, volume over ad safety. Almost by definition, right?
And that leads directly to maybe the most sobering finding in these documents, Meta's really deep involvement in global crime. There was an internal presentation drafted by Meta's own safety staff back in May 2025, apparently, and it estimated that the company's platforms are involved in, well, get this, a third of all successful scams in the U.S.
A third of successful scams.
A third. That's not just showing the ad, mind you. That's involvement in the whole pipeline that leads to people actually losing their money. The platform isn't just a neutral channel in this picture. It's acting like critical infrastructure for financial fraud on a massive scale.
That statistic, it puts Meta in a totally different category operationally, doesn't it? The report citing these documents, they describe Meta as a pillar of the global fraud economy. That's a heavy label. And, to make this abstract number, this $16 billion, feel real, you just have to look at the stories, the anecdotes of fraud that are becoming so common now, and increasingly sophisticated, too.
Oh, the sophistication is ramping up incredibly fast, and a big driver of that is generative AI. We're seeing this significant rise in deepfake financial scams that really leverage the targeting power Meta offers. For example, reports detailed scam networks using deepfakes to impersonate really high-profile public figures. They successfully used AI-generated video and audio to mimic the UK political leader Keir Starmer, even Prince William, the Duke of Cambridge. And these deepfakes, they were then advertised directly on Facebook and Instagram to push fake cryptocurrency investment schemes.
Wow. Okay, that takes more than just good tech skills to create the deepfake itself. It implies they have massive financial resources behind them too, right? To buy enough ad inventory on Meta to spread that fake video widely.
Yeah.
Which ties right back to the profitability Meta offers these groups.
Exactly, it connects directly. And it's not just investment fraud either. The internal reports also documented how fraudulent ID vendors are using Meta's really precise targeting system. They were apparently selling things like fake British passports, other EU documents, and often targeting specific vulnerable groups, like men aged 25-54 across various European countries. It suggests they were tailoring their sales pitch, their ad buys, based on who they inferred might be interested in immigration or maybe illicit travel.
So these aren't just like small-time crooks. These sound like sophisticated, high-volume criminal operations. And they're basically using Meta's own data-driven targeting systems to find their victims with almost surgical precision. The platform is handing them the tools for high-level social engineering and document fraud. Okay, let's try to unpack this a bit then. If Meta knows the scale of the problem, I mean, we're talking $7 billion, maybe $16 billion in revenue, 15 billion scam ad views daily, deepfakes of world leaders. Why aren't they just stopping it? The sheer size of it suggests they could stop it if they really, really wanted to. The answer, according to these internal documents, seems to lie in a really controversial internal policy, one that highlights this fundamental conflict of motives baked right into their system.
That conflict is really the engine driving this whole crisis, you're right. It's the constant tension between maximizing profit, which, is fueled by getting lots of ad spending, state, and ensuring user protection, which actually requires blocking some of those high-spending accounts. Their advertising architecture seems inherently designed to favor keeping the revenue flowing over aggressively removing the bad actors.
And this sort of profit-first stance, it's actually formalized in their policy for handling these highly questionable advertisers, specifically with something they apparently call the 95% certainty rule. Can you tell us exactly what that high bar means in practice?
Yeah, it basically means the burden of proof needed to permanently remove an advertiser is set incredibly high. Meta's policy, the one that dictates whether an automated system can just shut down an advertiser for good, it depends on that system predicting a 95% certainty of fraud. So think about that. If the detection algorithm looks at an ad, it's targeting the website it links to, and it's, say, 94% sure it's a scam, Meta's policy is often to allow it to continue running.
Wait, hold on. If they have an automated system that comes back with a 94% confidence score that's incredibly high, saying this is probably a fraudster, isn't the responsible thing to do just block them immediately? Why set the bar way up at 95%? What's the logic there?
Well, that 1 percentage point difference, that's potentially where the billion-dollar gap lies. The reason tech platforms often give is the fear of false positives.
Right.
If they block an advertiser at, say, 90% certainty, they risk blocking a legitimate business, one that spent money and now suddenly can't reach its customers. And legitimate advertisers, they're Meta's core business. False positives cost them long-term trust and, crucially, future revenue from those good advertisers. But by setting that threshold way up at 95%, they are effectively making an explicit statement. They're saying that keeping the revenue flowing from these high-probability scammers is preferable to risking even a minor loss of revenue from potentially blocking a legitimate advertiser by mistake. It basically formalizes a policy of tolerating a significant level of high-probability fraud.
Okay, so if they suspect it's a scam, maybe with 94% confidence, they don't block the ad. They don't block the advertiser. Instead, they do something far more financially interesting for Meta, apparently.
Yeah.
Something that turns this very ambiguity into high-margin revenue for them. They implement these penalty bids.
Yes, the penalty bid mechanism, it's really the technical key to understanding how this dark revenue stream works. And while it's a piece of policy that feels profoundly cynical when you look at it, for those suspicious advertisers who fall below that really strict 95% certainty threshold, maybe they score 80% or 90% on the fraud probability scale. Meta essentially forces them to participate in the ad auction, but they have to bid at significantly higher rates. They get charged premium prices, these penalty bids, to win the same ad space.
Can we break down that mechanism a bit more? Is it like a fixed surcharge? Or does the penalty actually increase based on how likely they think the advertiser is a scammer?
Yeah.
Like a 90% certain scammer pays an even bigger penalty than a 70% one.
Well, the internal documents didn't seem to provide the exact, proprietary formula they use, but the mechanism basically functions as a kind of risk-based surcharge. An account they deem highly suspicious might see its bid cost inflated by, say, 30% or maybe even 50% above what a trusted, known account would pay for the exact same ad inventory. The system seems to adjust the penalty dynamically based on that algorithmic assessment of risk. So yes, the higher the suspicion score, the higher the penalty bid is likely to be. This ensures Meta maximizes its revenue extraction from the very accounts it suspects are fraudulent, maybe even accounts it's about to ban eventually anyway.
The irony there is just staggering, isn't it? This mechanism, it's supposedly framed as a way to deter scammers, right? By increasing their operating costs, making advertising less profitable for them theoretically. But what it really seems to ensure is that Meta profits handsomely from the very advertisers they know are highly likely to be fraudulent. It feels like they're turning regulatory risk management itself into a source of premium revenue.
It absolutely creates this perfectly profitable gray zone for them. It literally turns suspicion into a high-margin revenue stream. And the company apparently acknowledged this irony internally. Some documents referred to these penalty bids as a centerpiece of their efforts to reduce scams. But then you look at the financial outcome, the collection of that $7 billion to $16 billion in dark revenue, and the practical result is clearly monetization, not deterrence. It seems like they're treating the potential fines from regulators as just a predictable cost of doing business, a cost that's easily offset by the premium revenue they generate through this penalty mechanism.
And this whole policy approach, it leads us straight into the moderation dilemma. It reveals what seems like a shocking level of internal disregard for the safety reports coming from actual users. This isn't just about the automated systems failing. It looks like it's about institutional priorities when humans could potentially intervene.
Yeah, the figures around how they handle user reports are genuinely alarming. And they seem to demonstrate a deliberate policy of, letting the system be overloaded. Back in 2023, Meta users were apparently doing their part, flagging fraud pretty diligently. They were submitting about 100,000 valid fraud reports every single week. And these are reports that Meta's own internal processes verified as legitimate complaints about fraudulent activity happening on their platforms. However, the internal documents then showed that Meta effectively ignored or incorrectly rejected 96% of them.
96%. I have to push back on that statistic for just a second. Is it possible that the automated systems are just completely overwhelmed? You mentioned 15 billion ads daily. Could this 96% failure rate just be a reflection of system overload rather than, deliberate disregard?
That's a fair question to ask, definitely. But the internal analysis seems to suggest it's actually both. Volume is certainly a huge factor, no doubt about it. But the documents also indicated that the company's internal goals were set to reduce this failure rate down to only 75% in the future. Now, if a 75% failure rate is considered an acceptable target for improvement, that signals a pretty clear policy choice to tolerate a very high level of failure. It means if you, the user, took the time and effort to identify and report a clear scam, there was an almost certain chance your report would just be dismissed or ignored. The system appears designed to filter out the vast majority of complaints that would otherwise require costly human review and intervention.
And this tolerance level for fraud, it apparently extends even to repeat offenders. but with a really important catch, right? It depends on how much money they spend.
That's probably the most blatant example of prioritizing profit directly over policy enforcement. The internal leniency rules, as described, are rigidly stratified based purely on the advertiser's spending capacity. So, small advertisers, the average scammers running maybe low-volume, low-budget fraud operations, they would typically have to be flagged for financial fraud at least 8 times before their account might be permanently blocked. But the rules for the high-value accounts, the HVAs as they call them, these are the massive spenders who pump huge amounts of money into Meta's ad system. Those rules were apparently far, far looser.
How loose are we talking here? What does looser mean for a big spender?
Well, according to the documents, these large advertisers, the ones deemed strategically important for hitting revenue targets, they could rack up over 500 strikes for fraudulent or prohibited behavior and still not necessarily be shut down.
500 strikes.
Over 500. This looks like clear, documented evidence that spending power correlates directly with policy tolerance. The company was essentially willing to overlook potentially hundreds of validated instances of high-value fraud if the advertiser was bringing in massive, consistent revenue. It really shows a complete breakdown of policy fairness, doesn't it? Where money effectively buys you immunity from the rules.
And we really can't ignore the context of staffing around all this either, because this massive volume of fraud seemed to surge right around the time Meta made major internal cuts, especially to safety teams.
Precisely. The timing is very suggestive. The internal documents did suggest that the staff layoffs Meta carried out in 2023, remember that big company-wide push to become leaner and refocus on AI? Well, those cuts apparently significantly weakened policy enforcement and gutted some of the teams responsible for brand safety and integrity. Resources were reportedly shifted away from those areas and prioritized for the massive new investments in AI and VR development, that multi-billion-dollar bet on the metaverse taking away from essential compliance functions.
So the institutional decision seems pretty clear then. The money, the budget that could have been used to hire more human moderators, more safety staff, maybe build better tools, that was instead redirected to fund the big AI CapEx push.
Yeah, one document apparently noted that the entire team responsible for protecting brand rights was laid off completely, and the remaining safety teams were explicitly told to operate with minimal resources, just enough to keep the system running. This institutional decision to effectively deprioritize safety seems to directly correlate with the timing of this surge in dark revenue. The system was already optimized for profitability, and the staffing cuts appear to have ensured that human intervention couldn't effectively challenge those automated revenue-focused mechanisms anymore. So if Meta is, actively profiting from all this ambiguity through things like penalty bids and showing this high tolerance for repeat offenders, it's no surprise that regulators worldwide are starting to draw much clearer lines in the sand, especially when it comes to financial fraud. And this means the immediate costs and the future costs of ignoring these scams are rapidly going up. It's transforming what might have seemed like a governance issue into a major tangible financial risk for the company.
Right. And the U.S. is definitely stepping up its scrutiny, it seems. We know the U.S. Securities and Exchange Commission, the SEC, is actively investigating Meta, and specifically looking into fraudulent investment advertisements on their platforms. What kind of legal and financial trouble could that investigation potentially create for Meta?
Well, an SEC investigation like that raises the real possibility of severe financial penalties, probably shareholder lawsuits down the line, and maybe long-term compliance mandates being imposed. The focus on fraudulent investment ads, the deep fake celebrity crypto pitches, the fake government bond schemes we talked about that links Meta's ad delivery system directly to market manipulation and fraud that causes huge financial losses for users. If the SEC brings a successful case, it could easily lead to a significant fine, maybe measured in hundreds of millions, perhaps even billions of dollars. And crucially, it could demand structural changes to their ad review process itself, which would directly threaten that $16 billion, or at least the $7 billion high-risk revenue stream.
And the findings coming out of other countries, like the UK, are maybe even more alarming, because they actually try to quantify the damage Meta's platforms are involved in. You summarize this critical finding from UK regulators. Meta's platforms were involved in an absolutely astonishing 54% of all payments-related scam losses in the UK in 2023.
54%. Yeah, you really have to pause and let that figure sink in. That's more than half of all the money lost to payments fraud in one of the world's major economies, the UK, tied directly back to activity happening on Meta's platforms, Facebook and Instagram primarily. That level of market dominance in, facilitating crime, It's pretty much unprecedented for a single company.
In the UK regulators report, it also noted that this 54% figure was more than double the involvement of all the other social platforms combined.
Right, so why? Why is Meta's platform apparently so much worse at handling this kind of fraud compared to, say, Google or maybe TikTok? What is it about their specific architecture that makes it such a haven? It's interesting because the internal documents actually seem to answer that question themselves with a pretty devastating admission. One internal document apparently acknowledged flat out that it was, quote, easier to run scams on Meta than on Google. And the reason seems to lie in a couple of areas we've touched on. First, that penalty bid system, which effectively monetizes questionable activity instead of just blocking it. And second, the data architecture itself. Meta's system allows for extremely granular targeting based on really sensitive personal data, which just makes social engineering scams far more effective. Scammers can pinpoint demographics known to be vulnerable to specific types of financial pitches with incredible accuracy. Furthermore, Google has historically had somewhat stricter pre-publication review processes, especially for financial services advertising. Meta's approach high volume, mostly automated approval, combined with those high tolerance thresholds we discussed, just makes it the path of least resistance for these sophisticated criminal groups.
Okay, so we've got clear evidence of the harm being done, growing pressure from regulators, looming investigations. Now, let's talk about the cold hard numbers. The cost-benefit analysis of crime, basically, as calculated inside Meta's own financial planning departments, according to these documents.
Yeah, this is where the internal documents really seem to expose the company's, let's call it cynical financial calculus. Meta internally acknowledged that regulatory fines for allowing scam ads are basically certain. They expect them, and based on various actions happening globally, they apparently anticipate penalties adding up to maybe $1 billion over a specific time frame. Now, $1 billion sounds enormous, right? That's a heavy fine for almost any company. But you absolutely have to contrast it directly with the revenue they are reportedly pulling in from this exact same activity.
Okay, so what is that direct contrast? What are the numbers they're comparing?
Well, Meta apparently calculated that it earns roughly $3.5 billion every 6 months just from those high-risk ads, the ones deemed to present higher legal risk, the very category that regulators are targeting. So doing the math, the internal calculation explicitly suggests that the expected $1 billion maximum fine is significantly smaller than the $7 billion they generate every year from this potentially illicit activity.
Right, so that makes the fine look less like a punishment and more like, I don't know, a predictable, maybe even necessary cost of doing business, like a minimal tax they pay on their dark revenue stream. They're basically paying a fee that is substantially less than the profits they're generating from the activity that incurs the fee.
Exactly. From a purely rational, albeit maybe morally questionable business perspective, it makes sense. Maximize the profits you can get from these high-risk sources, treat the inevitable fines as just a manageable operating expense, and you still net a huge profit. This kind of structure strongly suggests that Meta's current leadership sees no fundamental financial reason to eliminate this revenue stream entirely. It's still highly profitable even with the expected fine.
And just to make this prioritization of profit over safety even more concrete, the internal documents apparently even detailed a hard financial limit placed on the safety team's budget for compliance work.
Yes, this is possibly the most damning piece of financial evidence regarding their priorities. Internal documents revealed that, at least for the first half of 2025, the safety team was explicitly restricted. They were told they could not take any operational action, whether that was hiring more human reviewers, implementing a stricter AI tool for pre-publication checks, or maybe redesigning the whole ad review process. If that action was projected to cost the company more than 0.15% of total revenue.
Okay, let's put a dollar figure on that 0.15% cap. What does that translate to?
Well, given their projected revenue of around $90 billion for the first half of 2025, that compliance cap works out to approximately $135 million. So this set a very clear, very hard financial ceiling on safety efforts. It means, hypothetically, if solving a systemic fraud problem, one that costs users globally billions of dollars, would require an investment of, say, $136 million. The safety team was mandated to basically ignore it or find a cheaper, less effective solution. $135 million was the maximum acceptable financial pain Meta was willing to endure for compliance, regardless of the ethical stakes or the sheer volume of scams getting through. It acts like a firewall against any truly effective, potentially costly safety reform.
Let's maybe shift focus globally for a moment now and look towards the Asian market, specifically Thailand, because it really illustrates the global nature of this fraud, its sophistication, and how AI is accelerating things, maybe even outside the immediate glare of US and EU regulators.
Absolutely. The Asia-Pacific region is a major hub for online fraud, unfortunately. And Thailand provides a pretty grim high-tech case study. Between March 2022 and May 2024 alone, the Thai economy lost an estimated 63 billion Thai baht. That's roughly 1.8 billion US dollars, lost to online fraud in just over 2 years. And reports suggest a substantial portion of this crime is fueled by advertising placed on major global platforms, which includes Meta's platforms.
And this is where AI really seems to be weaponizing the crime, isn't it? Pushing past the standard security measures we thought were reliable.
Definitely. They're using deepfakes now to impersonate authority figures, which creates this huge crisis of trust. One really shocking scheme involved criminal networks using deepfakes to impersonate actual police officers during live video calls with victims. They'd catch people completely off guard, sound and look convincing, and coerce them into making money transfers. Hundreds of victims fell for it. Another high-profile case involved an AI-assisted scam call that actually tried to extort the Thai Prime Minister herself, Paetongtarn Shinawatra, using incredibly convincing AI-generated voice cloning technology. The tech just makes that initial social engineering step almost foolproof if you're not expecting it.
And they're even using AI now to get around established, often mandatory security measures like biometric authentication for banking. That feels like a really significant technical leap for criminals.
It is. And that's the terrifying case of the gold factory scheme that emerged in Thailand. The Bank of Thailand had recently mandated that high-value digital money transfers required biometric authentication, usually facial recognition, to verify the user's identity before the transaction could go through. The idea was obviously to curb fraud. Well, this hacking group, Gold Factory, responded almost immediately. They utilized face-swapping AI. They'd trick users into installing some kind of masked application, maybe disguised as something else. This app would capture just a simple video clip of the user's face. Then they'd use AI to generate a convincing deepfake video from that clip, one that could fool the bank's facial recognition system during the authentication step. This allowed them to bypass a security measure and siphon money directly from victim accounts.
Wow. That is a real-time regulatory cat-and-mouse game. And it sounds like the regulators, are currently losing ground to the speed of generative AI development. But you mentioned the Thai government is demonstrating a proactive counter-effort. Some of that contrasts pretty sharply with Meta's apparent slow approach to moderation, right?
Yes. They recognized pretty quickly that centralized, technology-driven, rapid response was probably the only way to combat the sheer speed of online fraud. So they established the Anti-Online Scam Operations Center, or AOC 1441. It's the centralized body that uses AI and big data analytics to investigate scam reports really quickly. And crucially, it has the authority and the technical means to freeze fraudulent bank accounts within minutes of a victim reporting the crime via their 247 hotline. This rapid response mechanism, according to initial reports, drastically curbed the daily financial damage from scams by over 36%. It really demonstrates that effective, technology-driven intervention is possible when you have the political will and the centralized resources focused on public safety rather than, say, internal revenue quotas.
Okay, this is where it gets really interesting, I think. For investors, for the market, we've laid out the dark revenue stream, the moderation failures, the growing global regulatory risk. So how does all this exposure actually affect Meta's massive future plans, especially its stock valuation and that huge multi-billion-dollar bet they're making on the AI supercycle?
Well, that $16 billion potential revenue stream, or even the $7 billion high-risk part, it's not just a rounding error on their balance sheet. It seems intrinsically tied to the company's whole valuation story, which is built on relentless high-margin growth. Now, if regulators worldwide really start cracking down following the lead of the SEC, the UK authorities, and force full structural compliance, meaning a true zero-tolerance approach to this high-risk advertising, then Meta risks potentially losing that full 10% of its total revenue. And in the financial world, losing 10% of your total revenue overnight, that's a massive negative shock to anyone's future earnings forecasts.
How does the market typically react to or price in this kind of governance risk when it becomes apparent?
It creates significant uncertainty, and markets absolutely hate uncertainty. When a company's revenue quality is compromised, meaning a big chunk of that revenue looks volatile, potentially illegal, or just likely to be regulated away, investors start applying a risk discount. This directly affects the valuation multiples they're willing to pay, like the price-to-earnings PE ratio. If 10% of Meta's highly profitable ad revenue is suddenly seen as structurally unstable, the market will likely reduce the premium it's willing to pay for Meta's future growth story. Plain and simple.
And the market did react immediately when these documents leaked, didn't it? Confirming that sensitivity.
It did, yeah. The revelations about these internal documents contributed directly to some significant downward pressure on Meta's stock price. Right after the leak became public, the stock saw an immediate 2.3% drop just in morning trading, and that added to what was already a bad week, an overall 17.5% drop within that single week. This drop was actually consequential enough to impact CEO Mark Zuckerberg's personal wealth ranking globally, pushing him down 3 spots. So the market is clearly sensitive to this idea that maybe 10% of their fundamental revenue base might be structurally unsound or potentially about to be regulated out of existence.
So the real question becomes, how do they plan to fund their incredibly aggressive pivot towards AI? A pivot that requires just massive capital expenditure, especially when the very revenue foundation that's supposed to support it seems so shaky, or at least ethically compromised.
This really is the ultimate paradox at the heart of Meta right now. They announced they're entering this unprecedented capital expenditure supercycle, a CapEx supercycle. They've committed to dramatically increasing their CapEx spending, earmarking up to $70 to $72 billion over the next few years. And that's primarily going towards building the necessary data centers and buying the massive amounts of advanced GPUs they need for their AI infrastructure ambitions. This is a truly staggering financial commitment, and it absolutely requires sustained, robust cash flow coming in from the existing business.
Okay, so how does that dark revenue stream, that $16 billion, tie into this giant spending plan? Is it possible that this money, while morally questionable perhaps, is actually necessary for them to keep the AI lights on, so to speak?
Well, the connection is maybe implicit, but it seems undeniable when you look at the numbers. Mark Zuckerberg himself publicly justified this huge expenditure by stating, essentially, that the core ad business revenue is strong enough, robust enough to support this massive AI investment. So the viability of their entire AI and metaverse future, their multi-billion-dollar bet on achieving superintelligence, someday it seems intrinsically linked to the continued strong performance of that ad business. Now, if you suddenly erode that $16 billion dark revenue stream through regulation, the immediate pressure on their cash flow could potentially delay that CapEx timetable. It could slow down the pace of AI deployment. It might even force the company to take on debt. All of those outcomes would compromise their long-term vision. So yes, it seems plausible that the dark revenue stream provides a crucial source of the high-margin, immediate cash flow needed to fund that future.
And this isn't just us speculating about market risk or financial necessity. Meta's own internal compliance goals, revealed in the documents, show that they fully expect to continue profiting from these illicit or questionable ads for years to come. Doesn't that basically prove the dark revenue is a planned, managed fixture in their financial model?
That's possibly the most startling piece of long-term planning that came out of these documents, yes. The internal compliance papers apparently laid out very specific goals. Not goals to eradicate this dark revenue, mind you, but merely to reduce its share over several years. They reportedly aim to reduce it from that initial 10.1% figure in 2024 down to maybe 7.3% by the end of 2025. And eventually the goal was apparently to get it down to 5.8% by 2027.
5.8%. Let that sink in. That means 3 years from now, the company's own internal target is still to have almost 6% of its massive multi-hundred billion-dollar revenue base derived from suspicious or prohibited advertising. That really confirms this isn't some accident they're scrambling to fix. It looks like a controlled, budgeted, ongoing revenue source for them.
It certainly appears to be treated as a persistent, maybe even permanent, part of their overall revenue base. Something to be managed down just enough, perhaps, to theoretically placate regulators and avoid the worst possible outcomes, but not managed down so much that it significantly impacts their cash flow or their big investment plans. The strategy looks pretty clear. Manage the volume of fraud just below whatever they perceive the regulatory tipping point to be, while ensuring the profits remain high enough to fund their AI revolution. It looks like a calculated decision to essentially manage a certain level of criminality as a cost-efficient strategy for massive capital deployment into AI. And if we try to connect all of this to the bigger picture, Meta's huge multi-billion-dollar bet on AI in the metaverse, fundamentally, that's a bet on long-term user adoption, it's a bet on partner trust, and it's a bet on broad societal acceptance of their vision. This ongoing ethical crisis, rooted as it seems to be in monetizing fraud and harmful content, it really undermines that entire vision, because a future built on deep distrust is inevitably going to be a fragile one.
Let's talk about the deep irony of the AI paradox here for a second. Meta is investing $70 billion plus to build the future, right? But the very technology they're developing, generative AI, is simultaneously making the present much more dangerous and harmful for their current users.
It really does create this kind of self-perpetuating, vicious cycle. It's like an AI arms race where the main casualties are the users caught in the middle. These massive corporate investments in generative AI inevitably accelerate the sophistication of online fraud globally. We're seeing it already. Generative AI makes deepfakes cheaper, faster, more realistic. It allows scammers to create automated, highly personalized scripts for social engineering attacks, enabling deception at an enormous scale like we saw with the Gold Factory scheme in Thailand. So this means the very technology Meta hopes will define its future is actively being weaponized against its users today. And at the same time, the company appears reluctant to spend the money truly necessary to build robust defensive AI systems, partly because of that, $135 million compliance spending cap we talked about.
This must also create a massive reputational headache for them.
Right. Going beyond just the immediate stock price hit, how is Meta's image potentially damaged among, say, legitimate advertisers and brand partners when it's seen as the place where crime is apparently easier to commit?
Well, the internal documents provided a really critical insight there. That internal admission that it was perceived as easier to run scams on Meta platforms than on major competitors, specifically naming Google, that perception alone translates into immediate reputational damage. Legitimate advertisers, the 90% plus who are funding the CapEx, honestly, they demand brand safety. They need platform integrity. If the platform is widely seen as inherently dirty or risky, it absolutely threatens the long-term relationship Meta has with those crucial brands. I mean, why would a major financial institution want its legitimate ad for, say, a mortgage product to run directly next to a sophisticated deepfake ad promoting some fraudulent crypto scheme? It's brand nightmare fuel. And maybe beyond the really obvious financial fraud concerns, the core issue here seems to be a much deeper erosion of trust, stemming perhaps from the foundational business model itself, surveillance advertising.
I think that's where the ethical conflict really becomes structural, yes. The surveillance advertising model, which is fundamentally built on harvesting vast amounts of personal and behavioral data to create these detailed profiles or types of users, that model inherently facilitates harm. Even when the advertiser's intent isn't malicious at all, we saw documented examples of this kind of systemic damage in the reports, sometimes called algorithmic trauma. For instance, users who had tragically suffered a miscarriage continued to be relentlessly bombarded with baby ads, parenting ads, because the profiling system was just too slow or unable to update the inferred behavioral data based on their new reality.
Or that other example about targeting vulnerability, the system essentially exploiting emotional crises for potential profit.
Exactly. That case of the Polish mother who was profiled as interested in oncology after a family member suffered a loss. She was then relentlessly shown distressing, sometimes graphic health-related ads because the algorithm simply inferred an interest in cancer treatment based on her browsing or interactions. The system, by its nature, is designed to identify and exploit potential emotional vulnerabilities for commercial gain. And the internal documents showed that even when users actively try to regain control, maybe by disabling sensitive interests in their settings or repeatedly hitting the hide post button, a follow-up study apparently showed those user controls were often ineffective. The underlying profiling engine just continues to push content based on its deep, often unwanted predictions about you. And that can reinforce trauma and anxiety. The harm is facilitated by the very architecture, not just by the explicitly bad actors exploiting it.
So, if we try to strip everything else away, what is the core ethical conflict here that prevents Meta, a company with seemingly unlimited resources, from truly cleaning up its act? Why would they plan to tolerate, even budget for, 5.8% of dark revenue way out in 2027?
The documents seem to make the answer pretty transparent, and it looks purely financial. Meta appears unwilling to implement truly rigorous pre-publication moderation for all ads, or provide the kind of essential transparency regulators keep asking for, like publishing full ad targeting details in its public ad library. And the reason seems to be that it simply fears the necessary revenue loss that would entail. If they were to implement truly strict pre-publication review, if they were to actually block all those 94% certain scams before they run, the financial hit would likely be immediate and severe. And that could risk their whole AI CapEx plan. So effectively, they seem to be choosing a predictable, calculated, ongoing profit stream, even if it demonstrably facilitates illegal activity, criminal enterprises, and causes systemic user trauma over fully safeguarding the public using their platforms.
Which brings us, I think, to our final evaluation for you, the listener, especially if you're trying to assess Meta's future as an economic powerhouse, as an investment.
Yeah, when you're assessing Meta today, you really have to weigh those two massive conflicting forces against each other. On one side, you absolutely have the spectacular potential of AI growth. It's driven by that $70 billion plus CapEx super cycle, the promise of revolutionizing consumer tech, advertising, maybe even society. And this potential is often reflected in Meta's typically high growth stock valuation. But on the other side, you have this substantial and increasingly quantifiable governance risk. It's represented by that $16 billion potential dark revenue stream, the ongoing regulatory investigations by the SEC and authorities worldwide, and now this internal evidence suggesting Meta systematically prioritizes its profit margins over user safety and platform integrity. So the crucial question for anyone looking at Meta is, which of these forces, the AI growth story or the governance risk reality, will ultimately dominate the company's long-term valuation and its future trajectory?
What are your thoughts on this deep dive into the dark side of Meta? We really hope this information helps you see the clear picture, or at least the complex relationship, between profit and responsibility for these tech giants. If you have any questions, or maybe you'd like us to analyze a specific stock or situation in a future deep dive, please do let us know. Finally, don't forget to like, share, and subscribe to support our team. Thank you for listening.
And maybe just one final provocative thought for you to mull over based on everything we've discussed today. Given that Meta's own internal documents show they fully expect to continue profiting from some significant level of high-risk advertising, for the foreseeable future, they're budgeting for nearly 6% of revenue from it by 2027. And considering that AI is simultaneously accelerating the power and sophistication of these scam enterprises, what fundamental responsibility does a platform of Meta's scale and influence truly owe to the global societies it operates within, when its core revenue-generating business model appears to actively facilitate criminal enterprises, often targeting the most vulnerable among us? Something to think about.